10 signs the U.S. economy might be on the brink of collapse. Did you know that the world's largest economy might be heading straight into a crisis, and hardly anyone is paying attention? We're not talking about conspiracy theories or baseless doomsday predictions. We're talking about real data. Declining GDP, slowing consumer spending, rising debt, all happening at once. And the scariest part? These cracks have already started to show. Stick with me until the end, because today we're going to look at 10 very clear signs that the U.S. economy is in trouble, and what that could mean for us and the rest of the world. 1. GDP is falling. Let's start with the most well-known economic indicator. GDP, gross domestic product. When it grows, it signals a strong economy. When it shrinks, it's a warning sign. In 2025, the U.S. GDP fell by 0.3% in the first quarter. Sounds like a small number? Maybe, but it's a clear, early sign of weakness. And here's the strange part. That drop happened even though companies were stockpiling goods in anticipation of possible trade tariffs. In other words, it was artificially boosted, not organic growth. Now think about this. If GDP fell despite that artificial push, what does that tell us about the real strength of the economy? And it doesn't stop there. Forecasts for the rest of 2025 show even more slowing ahead. Consulting firms like Deloitte and EY have already warned. Growth, which was 2.8% in 2024, could drop to 1.5% in 2025, and even 1.3% in 2026. That's nearly stagnation. But here's what's even more worrying. The biggest driver of U.S. GDP is household consumption, and that's cooling off too. 2. Consumer confidence is collapsing. You might think the economy's doing okay when you still see people spending. But what if I told you that behind all that spending, fear is actually in control? Consumer confidence in the U.S. has plummeted in 2025. And why does that matter? Because when people stop believing in a stable future, they stop spending. Simple as that. Household consumption makes up nearly 70% of U.S. GDP. So when consumers lose confidence, the entire economy shakes. Here's the thing. In the first quarter of 2025, consumer spending still grew 1.8%. Sounds okay, right? But the most recent data shows a sharp drop in confidence, according to analysis from Morningstar, the University of Michigan, and the Conference Board. And now, here's the question keeping economists up at night. Will spending continue, or will it eventually fall in line with people's growing pessimism? Historically, when consumer sentiment drops, spending soon follows. People stop buying cars, furniture, postpone travel, hold onto their cash. That sets off a domino effect. Less spending, less production, fewer jobs, more fear, even less spending. And one of the main triggers behind all this? Something you probably feel firsthand. The rising cost of living. Even when the data says inflation is under control, what really matters is how people perceive prices at the grocery store, in rent, in utility bills. And the perception is clear. Everything feels more expensive. When consumers feel their paycheck no longer stretches as far as it used to, confidence disappears. And without confidence, the economy becomes a house of cards. 3. The indicators are screaming. Recession ahead. Now let's talk about something most people overlook, but that major investors watch very closely. Leading economic indicators. The signals that show up before the storm hits. These indicators are like a lighthouse in the dark. They don't just show where the economy is, they show where it's heading. And what are they showing right now? A steady and alarming decline. The official index from the Conference Board that tracks these signals, called the LEI Leading Economic Index, has dropped for 3 consecutive months through February 2025. Historically, every time this happens, a recession tends to follow shortly after. And there's more. Even when the stock market seemed like the only bright spot, that changed instantly with the announcement of new tariffs. The result? The S&P 500 plunged. That's because the LEI isn't just some random number. It's made up of 10 key factors that help predict shifts in the economic cycle, such as new orders for consumer goods, building permits, consumer expectations, jobless claims, and even the interest rate spread. And most of these are worsening at the same time. Want an example? The drop in new orders for capital goods shows that businesses are pulling back on investments. That means less production, fewer hires, and shrinking confidence. Now, add to that the rising number of unemployment claims, and you get a very clear picture of a weakening real economy. What's most concerning is that these kinds of drops don't happen by accident. When multiple leading indicators start falling together, the risk of a crisis skyrockets. It's still too early to say a recession is guaranteed, but the signs are screaming. For the stock market has become a minefield. If there's one place where economic anxiety shows up almost in real time, it's the stock market. And in 2025, that market looks like it's stuck in a state of controlled panic. Just to give you an idea, right after former President Donald Trump announced new tariffs in April, the Morningstar U.S. Market Index dropped 20% in 1 week. Yes, 20% in just 7 days. That's not a normal dip, that's a collapse in confidence. Even though there was a partial rebound when the 90-day tariff pause was announced, the message was clear. Investors are nervous and reactive. Why should this matter to you, even if you don't invest in the stock market? Because when the market crashes, the shock waves spread fast. Companies delay hiring and investment. Consumers feel poorer and stop spending. Uncertainty rises, and the economy slows. It's the classic emotional domino effect. And the scariest part? The volatility isn't over yet. Morningstar strategist Dave Sekera had already warned that summer 2025 would be turbulent, with the return of tariffs and second quarter earnings results looming. And this isn't just about prices going up or down. It's the sentiment behind the numbers. A mix of fear, doubt, and anticipation that chips away at economic stability. Without confidence, the market freezes. Now let's be clear. The stock market is not the entire economy. It mostly reflects big corporations and wealthy investors. But here's the issue. It influences everyone's behavior. When the media says the market is down, business owners pull back. Workers postpone major purchases. The economy slows to a crawl. So even though the stock market is just one piece of the puzzle, it can be the spark that lights the fuse. And with so much political uncertainty, persistent inflation, and looming Federal Reserve decisions, this roller coaster is far from over. 5. The U.S. debt is out of control. Imagine someone who spends way more than they earn, constantly borrows money to pay off credit cards, and still promises expensive gifts to their friends. Now imagine that person is the U.S. government. In 2025, the U.S. national debt surpassed $36 trillion. $36 trillion. That's more than the combined economies of most countries on Earth. And the problem isn't just the size of the debt. It's how fast it's growing. Tax cuts, increased spending, stimulus programs, declining tax revenue due to unemployment. All of this has snowballed into something that's getting out of control. To give you an idea, the U.S. debt to GDP ratio is now one of the highest in the world and could reach 128% of GDP in the coming years. What does this mean in practice? First, more government money goes just to pay interest. The U.S. starts spending more on debt than on education, healthcare, or infrastructure. Second, the government competes with the private sector for money. That means businesses and everyday people pay more to borrow, since the government is soaking up capital from the market. Third, investors lose confidence. Moody's, one of the world's top credit rating agencies, downgraded the U.S. credit rating in May 2025. And when investors get nervous, they demand higher interest to lend money. Debt grows, risk grows, and suddenly, a fiscal crisis could emerge. This affects you, even if it feels distant. Why? Because when the government loses control of its finances, it's left with 3 bad options. 1. Cut spending, usually hitting the most vulnerable. 2. Raise taxes, hitting workers' wallets. 3. Print more money, which fuels inflation. None of these are good outcomes. And with interest rates rising, this hole is only getting deeper. 6. Inflation isn't going away. Remember when inflation was supposed to be transitory? Well, it seems like it packed its bags, moved to the U.S., and has no plans to leave. In 2025, prices are still climbing, and not by a little. In June, the Consumer Price Index rose 2.7% year over year. And the core CPI, which excludes food and energy, was even higher, 2.9%. That's well above the Federal Reserve's 2% target. It may not sound like much if you're just looking at the numbers. But in practice, your money is losing value every month. Why is this happening? Tariffs. With import tariffs back in place, companies are paying more to bring in goods. And soon, those costs hit consumers. Ongoing supply chain issues and shifting expectations. People are now expecting prices to rise. And when that happens, prices actually do rise. It becomes a vicious cycle. And the ones hit hardest are the ones with the least. Low-income families spend nearly everything on essentials, food, transport, rent. When those prices go up, nothing is left over. Worse, persistent inflation leaves the Federal Reserve with few options. They have to raise interest rates to cool inflation. But higher rates slow the economy, choke credit, and increase the risk of recession. In short, high inflation is like slow-acting poison. Even if the economy seems to be running, it's becoming weaker and more unstable, like a car accelerating with the parking brake on. 7. The U.S. job market is losing momentum. When it comes to the economy, nothing speaks louder than jobs. If the labor market is strong, people earn, spend, invest. The cycle keeps going. But when it starts to slow, it's a warning something's not right. In 2025, U.S. employment data is sending a subtle, but serious, message. The unemployment rate dipped slightly in June to 4.1%. Sounds good, right? But hold on. That rate has been stuck between 4% and 4.2% for over a year. So it's not getting worse, but it's not getting better either. And when we look deeper, things get more concerning. Most new jobs came from the public sector, not the private sector, which is the true engine of the economy. Private sector hiring is slowing down. This suggests the market is growing more cautious. Businesses are holding off on hiring, waiting to see what happens. And analysts are already predicting what's next. Deloitte estimates unemployment could rise to 4.6% in 2026. Even the Federal Reserve expects the rate to go up in the coming quarters. What does this mean for the real economy? Fewer jobs, less income, lower spending. More competition for work, stagnant wages. More unemployed people, more pressure on the government budget. Plus, unemployment claims, often an early warning sign of crisis, are also rising. That supports what other indicators are already suggesting. The labor market is running out of steam. And the worst part? Most people don't realize it until they're already out of a job. The slowdown comes slowly, but when it hits hard. 8. The U.S. housing market is frozen. If there's one sector that impacts both the economy and everyday life, it's housing. Buying a home is the biggest investment most people ever make. So when that market slows down, it's not just construction that stalls. It's a signal that the engine of the economy may be sputtering. In 2025, the U.S. housing market is sending a clear message. It's stuck, frozen, paralyzed. Even J.P. Morgan used that word, frozen. Projected growth for the year? Just 3% or possibly less. Some are even predicting declines in home prices. Zillow forecast prices could drop 1.7% by March 2026. Sounds small? It may not be a crash like in 2008, but this kind of slowdown has deep effects. First, consumer confidence. When the value of your home falls, you feel poorer. Result? You spend less. Second, construction sector. Fewer home sales, fewer new builds, fewer jobs, less capital circulating. Third, high interest rates and mortgage rates around 6.5% are keeping many buyers out of the market. The Mortgage Bankers Association has already said, this isn't likely to improve anytime soon. On top of that, existing home sales are at their lowest levels in nearly 30 years. It's almost a complete freeze. Now think about this. If consumers aren't spending, construction isn't growing, and real estate credit is drying up, how does the economy keep moving? And there's more. A stagnant housing market raises the risk of loan defaults. And any uptick in foreclosures could snowball into something dangerous for banks and for the economy as a whole. 9. High interest rates and the inverted yield curve. What happens when money becomes more expensive? When banks charge more for loans and companies hesitate to invest? Yes, we're talking about interest rates, and in 2025, the Federal Reserve is still hitting the brakes. The Fed's mission is to tame persistent inflation. But to do that, it's keeping interest rates high. The result? More expensive loans, heavier mortgage payments, tighter credit for everyone. Companies pull back on investments. Families delay major purchases. Consumer spending slows down. And as if that weren't enough, there's another red flag on the radar. The yield curve is inverted. What does that mean? Normally, the government pays more interest to borrow money over 10 years than over 3 months. But when short-term bond yields rise above long-term yields, it signals something serious. Investors are expecting a recession. And here's the scary part. Historically, every time the yield curve stayed inverted for an extended period, a recession followed shortly after. As of July 2025, the inversion is still in place. Even though the 10-year yield has flirted with a rebound, short-term bonds are still yielding more. This reflects two major concerns. 1. A tight monetary policy. 2. Market distrust in the future of the economy. And when banks see this inversion, guess what they do? They tighten up. They lend less. Credit gets even harder to access. It's a vicious cycle. High interest rates plus tight credit plus market pessimism equals slower growth. 10. Rise in bankruptcies. If there's one sign that shows the economic pressure has reached its limit, it's this one, a rise in bankruptcies. In 2025, the data reveals something troubling. Bankruptcy inquiries have surged to their highest level since 2020. That's according to Legal Shield, which monitors these trends in real time. And the warning is clear. We could be facing a wave of bankruptcies in the second half of 2025. But what does this mean in practice? It means thousands of families are drowning in debt, seeing bankruptcy as the only way out. It means small and medium-sized businesses, the biggest job creators, are shutting down. And why is this happening? Because all the other factors we've discussed, high interest rates, inflation, unemployment, and tight credit, are pushing consumers and businesses to the brink. With the cost of living rising, wages stagnant, and loans becoming more expensive, many are burning through their savings. And when the money runs out, bankruptcy is what's left. But the impact isn't just financial. Bankruptcies have a deep psychological effect. When people see friends, neighbors, or local businesses going under, confidence drops. And then consumption slows down, investment disappears, and the economy slows even further. It's a vicious cycle, and the numbers from 2025 show that it's already begun. Which of these signs worries you the most? Comment below. Let's keep this conversation going. If you like this video, give it a thumbs up, subscribe to the channel, and turn on the notification bell so you don't miss future episodes.